Hi, Ms. S. Ammu, Assistant Professor, PG and Research Department of Commerce, St.Joseph College of Arts and Science, Autonomous, Cuddalore. Today we discuss about income tax law and practice under the head of capital gains. Introduction. As per Section 45, any profit or gains arising from transfer of a capital assets are called capital gain and are charged to tax under the head of capital gains. A capital gains is the increasing in capital assets value and it's realized when the asset is sold. Capital gains apply to any type of assets, including investments and those purchased for personal use. Income from capital gains is classified as short-term capital gains and long-term capital gains. Basis of charges. Capital gain attract tax liability only when the following essentials are satisfied. Capital asset. Assessee should have a capital asset. Transfer of capital asset. The capital asset held by the assessee should have been transferred. Transfer during the year. The transfer of capital asset should have take place during the financial year. Profit or gains on transfer. The asset transfer should have resulted in gain or profit. Exemption under specified sections. Such a capital gains arising or not exemption under specified sections 54, 54B, 54D, 54EC, 54EE, 54F, 54G and 54GA. Meaning of capital assets. Capital asset is defined to include properties of any kind, whether fixed or circulating, movable or immovable, tangible or intangible, except a few specified items. All other properties are capital assets. Capital assets as defined by Section 2, subsection 14, including the followings. Any kind of property held by an assessee, whether or not connected with the business or profession of the assessee. Any securities held by foreign institutional investors which has invested in such a securities accordance with the regulation made under the SEBI Act. Assets excluded in capital gain. The following assets are excluded from the definition of capital asset. Capital gain. Stock in trade held for business or profession. Any stock in trade or consumable stores or raw material held for business or profession. Asset held for personal use. Personal effects, that is immovable properties including wearing apparels, motor car, electronic appliances, refrigerator, furniture, etc. held for personal use by the taxpayer or any member of his family depend on him, but excluded jewelries, drawings, paintings, archaeological collections and any work of art. Rural agricultural land. Agricultural land is situated in rural areas. Gold deposit bonds. Gold deposit bonds issued under gold deposits or deposit certificate issued under the Gold Deposit Scheme 2015. Types of capital gain. Short-term capital gain and long-term capital gain. Short-term capital gain. Gain arised on transfer of short-term capital asset is termed as short-term capital gain. Long-term capital gain. Gain arising on transfer of long-term capital asset is termed as long-term capital gain. However, there are few exemptions to this rules, like gain on depreciable assets is always taxed as a short-term capital gain. Types of capital assets. Short-term capital assets, long-term capital assets. Financial assets like listed shares, debentures, equity-oriented mutual fund units is holding less than 12 months is considered as a short-term capital assets. So more than 12-month duration is considered as a long-term capital assets. Unlisted shares is less than 24 months is considered as a short-term capital assets. So more than 24 months is considered as a long-term capital asset. Non-financial assets like house property and non-agricultural land is less than 24 months. In long-term capital assets, more than 24 months. Assets subject to depreciation. Machineries and furniture is a short-term capital asset. Diamonds less than 36 months is considered for short-term capital asset. More than 36 months is considered as a long-term capital asset. Format for computation of short-term capital gain. First, sales consideration. Sales consideration means the sale value of the asset. Then less expenses on sales, we get net sale consideration. After that, we less cost of acquisition including expenses on acquisition, less cost of improvement. After that, we get short-term capital gain. Then we less exemption under section 54B and 54D, we get taxable short-term capital gain. Then format for computation of long-term capital gain. Sales consideration, less expenses on sales, we get net sale consideration. Then less indexed cost of acquisition and less indexed cost of improvement, we get long-term capital gain. After that, the exemption under section 54, 54B, 54EC, 54F, we get taxable long-term capital gain. Thank you.